sharing experiences, really important, learning from each other, hearing from our expert speakers.
I want everyone to really take control of their health, because it's your body and your life, and if you're not in control of it, no one else will be.
Turns out that almost all pacemakers are completely fine to go through an MRI scan.
Both septal ablation and surgical treatment show good results. They're safe, they're comparable.
HRT for many women is a lifesaver.
However, and it was a real shock, they told me I did need a transplant.
It's funny being a carer. You know, sometimes people don't take their medicines properly and you get cross at, why are you not taking your medicines?
I would say the next big stage in the development of this story was our understanding that this is, in many people, a genetic condition. So it's a heritable and transmissible disease.
So some of the pros of genetic testing are that we can find a causative gene change in some people.
So living with cardiomyopathy certainly impacts on people's ability to live a normal sort of fulfilling life. And amongst that, it carries a lot of financial burden. It can certainly impact one's ability to hold down sustainable work. And it also brings with it an increased cost of living on a day-to-day basis. So what I try to do is to take a holistic approach, looking at the various aspects that anybody with cardiomyopathy, the difficulties that people living with cardiomyopathy are experiencing, and try and find solutions to those in using the welfare benefit system. A client that came to me recently stated that she has significant issues in managing a number of her day-to-day living activities, and therefore she doesn't necessarily feel as independent as she would like to be. So we had a long discussion and decided to pursue a claim for personal independence payment. We had a discussion through where there may be an entitlement, where she would pick up points, and we were successful in an application. She was actually awarded the enhanced rate for both elements, and as a result of that, she was able to swap some of her mobility allowance and get a car for herself, and also bring in a cleaner as well to help her with her tasks around the house. So in sort of adopting this holistic approach, we were able to find a solution to the problem, and that's kind of how I roll in my interactions with cardiomyopathy, with the cardiomyopathy community. Sure, very much so. So as I said, I really look at the whole sort of picture holistically. So we can look at sort of means tested benefits like universal credit. If somebody is working on a low income or not working, we can sort of find income replacement benefits there as well to go alongside sort of non-means tested benefits like personal independence payment. We also look at what support may be available through the local authority, things with council tax support, and maybe any sort of discretionary funds that may be available to help with rental shortfalls, as well as other sort of, say, more practical things like blue badge applications, bus passes, that sort of thing. So yeah, I really think that feeds into the whole holistic approach that I try and offer. In terms of blue badge specifically, blue badge applications are assessed simply based on the difficulty that somebody would have with mobilising. So that could be things like any pain somebody may be experiencing, any sort of breathlessness, fatigue, slower walking pace. So I would say that from my experience of getting to know a lot more about cardiomyopathy, it's certainly a condition that may sort of invoke those restrictions. And if we're able to sort of meet the evidential requirements, there would be nothing to suggest that a blue badge may not be an option as well. Sure. So, yeah, when sort of pursuing a PIP application, I would certainly go through each of the descriptors that PIP looks at, both for the daily living element and the mobility component. Just take an example of one sort of descriptor. So the first descriptor that PIP looks at is any difficulties that there may be in somebody preparing a meal for themselves from fresh. So what I would do in sort of understanding the restrictions, say specifically looking at the fatigue side of things, would be to focus on whether somebody is sort of able to stand for long periods of time without sort of feeling dizzy or uneven on their feet, whether they need to sort of sit down, whether they need to take breaks, preparing a meal for themselves to sort of regain their composure, which would obviously then lead to it taking a longer period of time to complete that activity. And these are all factors that PIP can sort of consider. So if one is unable to complete an activity to what's called an acceptable standard in a reasonable length of time, repeatedly being if it takes longer if it takes 50% longer for somebody to complete than an able-bodied person, these are all factors that can be taken into account in assessing whether somebody is restricted for the purposes of making a successful PIP application. Sure. So as I said before, PIP is really assessed on how things are for the majority of the time. So when I'm sort of going through that, at the point of application, I will sort of get a basis of how things are at that point. And what PIP really assesses as well, how things were 3 months before the date of the claim, with an expectation that the sort of difficulties would be there for a further 9 months. So we're kind of looking, a lot of it is on the balance of probabilities, obviously. So yeah, just really sort of looking at that, sort of back the way and how things are likely to be for the following 9 months after the initial 3 months going back the way. So that's sort of how, that's sort of starting point, I guess, for assessing where restrictions may lie. A challenging process, that's good, Adrian? Great. Once you receive a decision, if you are not happy with it, the first stage of the appeal process is to ask for what's called a mandatory reconsideration. What that means is you're asking a different decision maker from PIP to have a look at the decision again, seeing whether anything has been missed out, getting them to have a look again at anything that you dispute, any maybe evidence that you think that has been omitted, any new evidence that's come to light that you wish to sort of send in again to support that, very welcome to do so. That then goes off to the Department for Work and Pensions. What I would say at this point, and it's where a lot of people maybe aren't aware of this, any communication from the DWP will make it clear that you have 1 month from the date of the decision to ask for a reconsideration. In practice, that's not true. You have up to 13 months from that date to ask for that. So if you miss that 1 month deadline, it's not a problem. You still have another 12 months to ask for that. So I don't know whether that sort of impacts as well people not challenging decisions because they aren't aware of the absolute time frame for asking for a reconsideration. So reconsideration goes in. It's very likely that the mandatory reconsideration will be upheld. I think current stats are suggesting only around about 20% mandatory reconsiderations are overturned at that stage. So the next stage after that would be to appeal to the independent tribunal. Independent tribunal is, as the name suggests, totally independent from the DWP. Goes out to the judiciary. PIP appeals can take many, many months to get a hearing or to get a decision. I would say roughly about a year to get a hearing. So tribunal panels are made up of essentially 3 people. You'd have a tribunal judge who is an expert in social security law. you'd have a medical doctor, and you'd also have a disability expert. And all three on the panel are very welcome to sort of ask questions about your health, which would be going back to the date of the original decision. Any changes that may have occurred in that time frame wouldn't be relevant because it would only be relating back to the original decision. There are three options in terms of how tribunals can be held. You're very welcome to ask for a paper-based hearing, so you wouldn't actually have to attend a hearing. Decision can be made on any sort of, on the paper, so any evidence that you've submitted. Ever since COVID, and I think it's a very good idea, tribunals have started holding remote hearings, so in this sort of format. And I think that encourages and opens the door to justice for people that may not be able to attend a physical hearing for whatever reason it may be, anxiety, mobility issues, whatever it may be. But of course, there is that option to physically attend a hearing if you want to. I am a very big advocate of in-person hearings, whether that be physically or online. I think that it gives an opportunity for the person who is appealing to give their sort of side of the story, and sort of gives them an opportunity to, in their own words, to express the difficulties that they're having. Yeah, I think it sort of works in their favour to do that. It sounds very daunting, but they are very chilled. Tribunals are sort of very inquisitorial by nature, but that's only because they want to sort of gain the understanding to make sure that they come to the right conclusion. What I would say on tribunals, around about 65 to 70% of cases that go to tribunal are overturned in favour of anybody appealing a decision. So it's always worth appealing it. And we've had some very good successes in my work with cardiomyopathy. So just a case in point, I attended a hearing a few weeks ago for a cardiomyopathy client. Was awarded initially nothing on the first application. That was then upheld at mandatory reconsideration stage, went to tribunal, and she was awarded enhanced for both elements, and that culminated in a backdate of just over £11,000.
That's Robert's final word on PIP. So we're going to now introduce William Bartholomew. So he's a wealth management partner, and he's come to talk today around finance and cardiomyopathy. So we're very grateful to Bill for coming along.
Thanks,
so if you've got any questions that you wanted for Robert around benefits, if you can put them on a piece of paper, hand them to Christy, who's at the back of the room. If you put your email address on, then we'll get those sent out, and then we'll get them put on the YouTube channel. And then if you've got any questions for Bill, if you just write them on a piece of paper, then Christy will collect those in at the end of Bill's talk, and then we'll do our best to ask all of the questions. We will generalise them, but we will do our best to answer all of them.
Hi. Is that working? Yeah, great. Well, thanks for that, Jane. And it's definitely Bill and not William. That's only if I was in trouble as a kid. And so, yeah, Bill it is. So I'm here this morning. I've been invited very kindly by Cardiomyopathy UK to just give you a very brief overview in respect of pensions and life insurance, and how, following a diagnosis of a cardiomyopathy, I may be able to help either that particular client or a family member. So I'll start with a little bit of background on myself as well. I was diagnosed with dilated cardiomyopathy back in December 1997, and I had my first ICD on the 23rd of December, so quite the Christmas present, I'm sure you'd agree. I had my fourth ICD earlier this year. So certainly the first one did its job as and when required, and I'm delighted to say that I've been very stable the past 20 odd years, so not needed any more of those nasty shocks, but still got the guardian angel clocking me inside, literally. I'd like to also just make you aware that I've been a financial advisor for the past 15 years, and I'm part of a large national network called True Potential. We're both regulated by the Financial Conduct Authority, and Christie's going to kindly have some of my business cards to hand out at the end, should you wish to get in contact with me if you have any further questions about what we're going to discuss and go through. Certainly in respect of one-to-one questions, it's much easier away from an open forum like this, so please do take a card if you prefer to speak to me about your situation more privately. I'd like to start with the pensions industry, and we could easily kill a day on that boring subject, and I'm sure a lot of you would be asleep by the time we'd finish, so I'm going to keep it very simplistic and an overview on that. Basically, you have two different types of pension arrangement. You have a personal pension arrangement, and you have a final salary scheme or occupational pension arrangement. So I'll start with the personal pension arrangements, if I may. Up until 2015, 90% of people with a personal pension, when they retired, would have bought what was called an annuity. So you'd go along to a big insurance company, Aviva, Zurich, etc., and you'd have your pot of money that you'd saved diligently for many, many years, and you'd say, okay, I'm going to give you this pot of money. How much income will you give me for the rest of my life? And they would say, okay, well, based on the amount you've got, your age, what you're looking for with this annuity, we will give you X number of pounds, and then if you chose to accept that offer, you would hand over your big pot of money, and you would have that income for the rest of your life. If you'd included the option to also have a spouse benefit, then upon your death, your spouse would receive potentially half of what you had signed up for. And on the spouse's death, that was the end of the fund, and the insurance company kept whatever was left in the fund. However, George Osborne decided in 2015, under something called pension freedoms, that if we've entrusted people to be careful with their money all their working lives, save up and accumulate a pension, we should also allow them the opportunity to spend it as and when they wished, and to trust them to not be, shall we say, a little bit more exuberant than might otherwise they would have been. Consequently, when it was first introduced, it earned the rather unfair nickname of Lamborghini pensions, because there was this expectation that some people would just go doolally. They suddenly had access to a huge amount of money within their pension fund, and they would go out and buy a Lamborghini. Obviously, there would have been one or two people that may have done that, but for most people, they had been prudent and sensible, and they wanted to make their monies last. But the other benefits that you got with the pension freedoms that you didn't have with the annuity was that you were able to access your pension as and when you wanted, in respect of the amount of income that you may wish to take from it. So obviously you'd still have to have met the minimum pension age, which would have been 55 and still is 55 now, for a personal pension arrangement, unless there were extenuating circumstances, so you were seriously ill, etc., but that would have been a very minority of cases. So you'd get to 55, you'd say, right, I want to start to access my pension now. My spouse and I are in pretty good health. We'd like to do that world cruise. We'd like to get a house extension done. We'd like to get the motorhome. Whatever had been your long-term goals and aspirations, all of a sudden you had the flexibility to access your money that you wouldn't previously have had. So obviously a lot of people were very, should we say, pleased to have that option available to them. It didn't mean that they went down the Lamborghini route. It meant that if they wanted to meet those certain goals and objectives, they were finally able to do so without the restraints of a restricted annuity providing them with £8,000 a year, for example. The other advantage was when they'd taken out or accessed the pension freedom side of things, was that they had that flexibility to take what they wanted from their pension. Quite likely a chunk of that would have been subject to tax, as you can imagine, but that to one side. But also, upon death of the pension member, the entirety of the fund that was left could go to the spouse, who could then enjoy the pension fund as they saw fit. But also, upon the spouse's death, whatever was then left was available to the children and dependents. And so it could become something that would really support generations going forward, dependent obviously on how much you've been accessing and how big the fund had grown. So, as I say, very simplistic view, that's where we're at now with personal pension arrangements. The other side of the coin is the defined benefit or occupational pension or final salary scheme pensions. They work in a very different way in that for each year that you're a member of the occupational pension scheme, you accrue a benefit. And that benefit is encashed, for want of a better word. Once you retire, and they look at how many years you've been working in the scheme and what your salary was at the time you finished working for that particular company. Now, these benefits or these pension schemes are a promise that you will have that benefit. They're not guaranteed, as, for example, with British Home Stores, and we all know what happened there, where the pension scheme failed. So whilst they're not guaranteed, it's very rare that anything like that does happen. But basically then, when you retire, you'll know exactly how much income you're going to have. You'll also have spousal benefit built into it. And your fund will not be exposed to the risks of markets with the volatility taking it up and down. So from an FCA, Financial Conduct Authority perspective, when an advisor will go along and talk to somebody, a client who's got a final salary scheme pension, we must always start from the position where that client is with their final salary scheme pension is the best for them. So you may then say, well, why am I talking about that with a view potentially to moving it to a personal pension arrangement? Well, basically, if somebody has been diagnosed with a serious condition, such as a cardiomyopathy, in the eyes of the actuaries, these guys who calculate everything within pensions industries and insurance companies, we're less likely to live as long as somebody who hasn't got that serious condition. Cold hard fact, as they say, in the eyes of the actuaries. So you may very well say, well, yeah, I've got this fantastic final salary scheme pension, but am I going to live long enough to really get the benefits of it? I'm in good health now. Who knows what's around the corner? I really do like the idea of that personal pension arrangement where I can access more money as and when, and whilst I'm still fit and able, rather than having the constraints of the normal final salary scheme, which is, right, you're retired now, you can have a certain amount of tax-free cash, and then you will be restricted to X number of pounds income per year, which will go up each year, and your spouse will have some. It may very well be that, yeah, that's nice, but you really want to enjoy your early years in retirement whilst you're able to. So that's where the conundrum can come about, and a lot of people who have got a final salary scheme and then get diagnosed with a serious condition actually start to contemplate moving out of that environment and going to a personal pension. And that, as I say, is something that I can help with regards to advice around that. So the next area that I'd like to move on to, and we'll take questions at the end if that's okay, just so that I can make sure I've got everything covered, is the life insurance. So with regards to life insurance, it sounds a fairly basic question. Oh, what is it? How does it work? Obviously, it is, again, or can be quite simplistic. So You have different types of life insurance. You would have, for example, term life insurance, which is where you have a set criteria. Let's say, for example, your mortgage. You've got a £100,000 mortgage. It's a 25-year term. You want to set some life insurance up to cover that in the event of your death so that the family can continue to live in the property. And for most people, that's what they would associate life insurance with, because that's a huge amount of the market is around that. You can also look at term assurance from a slightly different angle. Say, for example, you had one breadwinner in the family. They've got 2 or 3 children. We'll take the breadwinner as dad in this occasion. He's earning £40,000 a year, and the youngest child is 5. Now, heaven forbid, if something were to happen to dad, nothing at all to do with cardiomyopathy or any serious illnesses, just mundane, run-of-the-mill family, dad, no issues whatsoever. If something happens to him, whilst that youngest child is still financially dependent, and this is where it can open up a little bit of a Pandora's box, you've got to say, well, if that child's only 5, potentially they're going to be financially dependent till they finished uni. Well, that's in theory, as any of us who have had kids go to uni know it goes on for quite a bit after that, but that's by the by. So 22 years old, potentially, by the time they've finished uni and got their career up and running. So you're looking at 17 years of financial dependency still. And dad, the main breadwinner, has sadly died in a car crash or whatever. So you then start to look at it and say, well, how much of that family actually missed out on in terms of financial benefits? And a simple calculation is, right, well, it's 17 years. Dad was earning £40,000 a year. And then you can see how much income that family is suddenly missing out on. £680,000 worth. So you can see where life insurance could also come in outside of just protecting the mortgage. And then we have another type of insurance, that's whole of life insurance. This is much more expensive to set up because basically it's guaranteed to pay out at some point, provided the premiums are maintained. It's usually used in the context of inheritance tax, which is more and more in the news now. More and more people are getting dragged into the inheritance tax bans. And that's an extremely complicated area. All I would say is that there is something that you can use, whole of life insurance, to help mitigate that. And again, take a card, come back to me if you feel that that might be something you'd like to explore a little bit further. Then finally, we move then on to we've got the types of life insurance, and then we have the basis. So most people's mortgages are now decreasing. In the 80s, when some of us would have perhaps taken out our first mortgages, everyone went for interest only because the payments were really low and we didn't really worry or think about the future. So most people today, thankfully, have got decreasing mortgages. So you would want decreasing life cover to mirror it. So as the mortgage falls, your life cover falls. And that's the cheapest way to set up life insurance. Then you can have level cover. So for example, if you had an interest-only mortgage over 25 years, you're still going to owe after 25 years what you did at the beginning. So in that example, it's no good you setting up your life insurance to decrease because that's coming down to here and your mortgage is still up there. So level cover would be more applicable for that. We can also then start to say, well, yeah, level cover's good. Any options around that? There most certainly is. We could look at indexing that level cover. So for example, we might choose the rate of inflation. So you would start the plan off, it's over, say it's £100,000 level cover for 25 years. And we're going to index this because we want to preserve the value of that 100,000, because obviously in 25 years' time, 100,000 might be a meal out in McDonald's for the way that it goes with the inflation that we've had recently. So you want to make sure you preserve the value of it. So what happens with an indexed plan each 12 months on the anniversary of your policy, you're written to by the insurance company. They say, right, you've done a year now, you're 100,000, we've had 10% inflation, so you're now going to have £110,000 worth of cover. And as you'd expect, you can't have something for nothing, so your premium will go up very slightly because obviously you've got an extra £10,000 worth of cover. Now what you can do, let's say you're 10 years into the policy and you think, well, gosh, money's a little bit tight. I think I've got more than enough cover with this policy now. When they write to you for the anniversary, you can just simply contact them and say, don't want that to go up anymore, and they will freeze it. They say, okay, so you're now at £140,000 worth of cover, and your premium, for example, is £30 a month, and it will stay at that for the rest of the term. You can't go back to them after a couple of years and say, oh, can you unfreeze it now? I've got a bit more money. So you have to give it a little bit of thought before you actually press that freeze button. And as I say, once it's frozen, the premium stays the same and the level of cover stays the same right the way through the policy. Now, if you've got no illnesses, it's obviously very straightforward for anyone to set up life insurance, and certainly any financial advisor would be able to help you. But when you introduce something like a cardiomyopathy into the equation, I'm sure you'd agree, you'd be very hard pushed to find any financial advisor who could probably pronounce some of the conditions, never mind understand what they are. And that's where my sort of niche area has come in, because of the years working as a financial advisor and obviously even longer years having had the condition. I was soon aware that there is a need for somebody to help people, guide them, you know, through this process, because it can be extremely frustrating and you could end up paying considerably more for your cover than you need to, because the way that I operate, I've got the medical knowledge of all the different types of the conditions, from having attended all of these conferences since 2010 all over the country and listening regularly to Professor Elliott and Jerry Cartwright. So I've got that side of it, which helps me engage with the underwriters at all the insurance companies and say, okay, so what are you actually looking for this particular client? And the underwriting actually evolves over time. So I'll regularly speak to all the different underwriters, perhaps every 2 or 3 months, and say, anything changed now with regards to this cardiomyopathy, that cardiomyopathy, so that I'm fully up to date. That way, if I do get a new inquiry from somebody, I can dovetail it fairly quickly to the most likely company that can help. And if there are 2 or 3 companies that might be able to help, also the ones that would likely offer the lowest premium. Because when these insurance companies are considering an application, there's a number of different criteria, which could be, for example, the type of cardiomyopathy, the age of the client, any other illnesses, their BMI, family history, etc., etc. So you can see it's quite a complicated process. But by knowing what the insurance companies are looking for at an early stage, it just means that I know fairly soon into the process if we're likely to get cover, and also what the likely cost is going to be. So it just means you're not waiting around for months for failed applications. The next side of it that I'd just like to touch on there is, and there's a growing area for my business certainly, is that for parents diagnosed with a cardiomyopathy who have got children 18 plus, and how I might be able to help there. I mean, as a parent, if we've got the condition and we've got children, it's always something that is in the back of our mind. Oh my goodness, I hope I haven't given this to my child. Quite often, through misguided thinking really, and not knowing any different, you can have parents and indeed siblings or children think, I'm not going to have any genetic testing, I'm not going to have any screening, because if I get those results and they're not in my favour, it means I'll never get life insurance. To be honest with you, it couldn't be further from the truth, because when you fill in any application form with any insurance company, there's always one particular question section, and it revolves around family history. So let's just say it might be your brother or your sister, you're the one with the condition. They're applying, up pops a question, have brothers, sisters, or parents, it's always immediate family, ever suffered from one of the following? There's a list of horrible conditions. Cardiomyopathy is one of them. And if you go, yep, sister, brother, mum, dad has had it, it immediately opens another sub-menu of questions when you're doing it online. Have you been tested for the condition? And by tested, it would mean a screening with at least an ECG and an echocardiogram, and that having been completed within the past 3 years. Some will go to 5 years, but the majority want it within 3 years. So if you've then got the sibling or the child that have refrained from being tested for fear of not getting life insurance, all of a sudden the question is saying, have you been tested? No. Go away and get tested is basically what the computer says to them, and come back and have a chat when you've been tested. So we know what we're quoting for, which is understandable to an extent. So it does then mean that the sibling or the child has to then book up for an echocardiogram. In respect of the gene testing, totally irrelevant with regards to cardiomyopathy if it's a negative or a positive gene testing. Because, quite simply, the only positive gene test result you need to declare is if you've had one for Huntington's disease and you're applying for life cover in excess of $500,000. So I've actually had instances where I've helped clients who were tested positive for the faulty gene, screened negative, and I've then been able to help them with their life insurance cover. So getting back to that, do not procrastinate around having these tests done in the misguided thought that, oh, it could impact on me getting life insurance. Likewise for your children, encourage them to get it done because it won't have any effect. If they've not had those tests, they will not get offered the cover. By the tests, I mean the screening. Now, the next thing that I wanted to just outline, because it was a question that I used to get asked more and more, was around residential mortgages and life insurance. There's no requirement for anyone with a standard residential mortgage to have life insurance. So often it was, will they be able to get a mortgage? Yes, you can. Putting it bluntly, if something happens to that person, the lender has got the property to sell and they will get their money back. So you don't need to have life insurance. There are certain bank loans, for example, for businesses, that type of thing. They may insist on life insurance then, but not for mortgages. So they're fine with that. One final thing I'd just like to raise was, again, with parents and children, is parents have been approaching me to try and help set up cover for their child. And I had mentioned this in the one presentation that I did with Jane earlier this year. But as I say, it's an area of growing inquiries. And the mum had contacted me and said, I've got cardiomyopathy. She had ARVC, which unfortunately means I can't help anyone with ARVC. It's not that it's any worse than any other cardiomyopathy. It's just that there's so little information about it that the insurance company are unable to calculate the risk, and therefore they say, we can't calculate the risk, we can't offer terms. So that's the bottom line with that and why they can't help. So she had ARVC and gave me the details on her son. He was 20, he's in university, and he'd been screened with negative results. So he'd had his echocardiogram, no signs of any cardiomyopathy whatsoever. So we were able to set up for him, we put in place £300,000 worth of life cover for 50 years, so it was going to take him to age 70. And we put in place 200,000 of critical illness cover. We could only do 40 years for that because that was the maximum. But you can see that's a considerable amount of cover that's put in place for him. And the costs on those, the life cover was coming out at £20 a month, and the critical illness cover was coming out at £40 per month. We also linked it to inflation. So because again, 50-year period, you know, we don't know what 300,000 will be worth then. So it's linked to inflation. It's always going to keep the benefits. And then when our son has finished uni, got himself a job, he can take over the payments for it then. And the advantage in doing it then was that if we'd left it and a son had been diagnosed with the cardiomyopathy, he would not have got life insurance at any price, and obviously he wouldn't have got critical illness cover. So she was delighted to have that in play for him. As far as I know, he's still testing negative, which is obviously great news. But yeah, it's an area that I'm exploring more and more with more and more clients. You know, you may not be able to help the parents, but you can certainly help the children. How are we doing for time? I was just going to say, yes, let's rock on with some questions then, and I'll see what I can do.
Yeah, if you can write them down. Okay, so this one, Bill, is about testing of children. So 28-year-olds, what if a child was tested over 5 years ago for HCM? Will they be asked to retest?
Almost certainly, yeah. As I say, they prefer a 3-year time lapse rather than anything longer. There are only 1 or 2 insurers that would consider 5 years. So yeah, 3 years is the ideal.
And would that be the same if they have a negative gene?
With the gene test, it's irrelevant, because even if they tested positive, they haven't got to declare it unless it were Huntington's and it was for more than 500,000. So gene tests never enter the equation, which is why, as I said, I've helped people who have tested positive for a faulty gene, but negative screenings. So it's even more important, if you like, to try and get the cover for those people whilst they're still able to do so and at a reasonable price.
Will the NHS retest?
I suppose it's down to your GP, your local cardiac centres, and the pressures that they're under. Certainly for clients that I've asked about this, I think the longest wait I've had was for a lady whose daughter had to be tested, and it was about 5 months. So it was held off until there. Usually if you explain the reason for it, you know, it's to do with some life insurance, it can cut a little bit of slack and might just push them up the queue. And certainly in my own example, when I had to have my latest ICD, I hadn't had an echocardiogram for about 8 years. And I just said, well, look, can we have one done? And they managed to push some buttons, and all of a sudden I was only waiting a week or so. So I think, you know, there's always worth asking, certainly in respect to that.
This one says, I have a lapse if I move to a personal pension. Would I lose my death in service?
Sorry? Oh, a local government,
pension, sorry.
Yeah. Well, again, it would come down to the scheme rules. Obviously, scheme rules rule, especially in that. So it would be a case of looking into your occupational pension and looking at the fine print. So that's where we would be with that. But certainly if you've not accessed it, then what I outlined earlier might be very well be something you may want to consider.
Another question is, what is the next best option to build a financial cushion if somebody is not insurable?
Okay, well, basically it's just to put money aside each month. Dependent on your risk appetite, you may want to put that into stocks and shares, ISAs, for example, to try and give it the opportunity to grow a little bit quicker. But outside of actually saving it, there isn't really any other options. I could say lottery tickets, but I mean that in itself is life. So no, that would be the only pragmatic way forward. Right? Okay, we're going to have a savings plan. It could be a cash ISA if you didn't want to take any risk. We're going to put in £50 a month, £100 a month, whatever you can afford over the long term. Then hopefully build up with that.
Thank you, Bill. And can under 18s get life insurance?
No, they have to be 18.
Okay, there's another question in regard to ARVC. So it says, are they not able to claim any insurance?
Unfortunately, no. And what you do find, not just with ARVC, but even DCM, HCM, you might be able to get life insurance. You will not get income protection. You will not get critical illness cover, even with exclusions. Exclusions are used when you have, let's say, your child, which was the example of that lady then with the son in university. So we got him his critical illness cover, but because of the family history of cardiomyopathy, that was excluded from his critical illness policy. Mum was still happy because everything else was covered. So yeah, if you've got a condition, any type of cardiomyopathy, the best you can hope for is life insurance.
Okay, that's all the questions.
Oh, fab. Okay.
Maybe they've all watched your YouTube video and they've
that's
had them
what
all
it must
answered.
be.
That's what it would be.
Well, thank you all.
So thank you very much to Bill and to Robert who came virtually. If you've got any questions for Robert, then please let us know and we'll send them forward. But thank you very much.